little background for those folks on the call. A quick introduction of Bill. Bill is the product specialist at Harvard Pilgrim, the nation's top-ranked private health plan. His primary focus is simply consumer-driven health plans. The objective of a CDHP, consumer-driven health plan, is to rearrange the way the employer allocates their benefit dollars by introducing deductible plans coupled with tax-advantaged reimbursement accounts to help employees pay for eligible expenses as they incur them. These reimbursement accounts include health reimbursement arrangements, otherwise known as HRAs, and health savings accounts, otherwise known as HSAs. Mr. Stewart has trained more than 900 brokers on these programs throughout the state and has done continuing education courses here in Massachusetts, New Hampshire, and Maine. He has installed more than 750 consumer-driven health plan programs with clients ranging in size from 2 employees to more than 2,000. He speaks at regional and national conferences on this exact topic. Mr. Stewart earned a Bachelor's of Arts from Bowdoin College and an MBA from Duke University. On behalf of Aisling Partners and Catalyst Benefits, we are delighted to have Bill here this morning, and let me turn the program over to him.
Good morning, and thank you, Todd. Let's jump right into the topic of CDH. We're going to spend probably about 35 to 40 minutes in the presentation, and then we'll have plenty of opportunity to answer your questions at the conclusion. One moment, please, while I get us to the next slide. Okay, there's the introduction to me, but you've already heard about me, so let's get right into the agenda and what we're going to do today. I want to talk really briefly about how we calculate premiums, particularly important for small groups, groups of 50 or fewer employees, because that kind of sets the frame of where we can go and what CDH can do for us. Then strategies to manage healthcare costs, and then focus on consumer-driven health as one of those strategies. We'll talk about high deductible health plans, health reimbursement arrangements, health savings accounts, and then get into which approach might be right for your company. So calculating premiums, it's important to understand the concept of how an insurer, Harvard Pilgrim or anybody else, calculates premiums. The first term I want to introduce is the concept of community rate. And community rating, an insurer simply places members into a pool to determine their average utilization. So for a small group of 5 employees, rather than looking at the claims of those 5 employees and rating the company that way, we put them into a pool that may have 1,000 other companies, each with 5 to 25 employees, and look at the average claims utilization within that community. The reason this concept is important is if you are an employer with 50 or fewer employees, state law in Massachusetts and most other states as well requires insurers to apply a community rate. So the importance of the community rate here is simply that it's designed so that there'll be no sudden shocks if you have bad utilization in 1 year. If you're a group of 5 and had something awful happen to several employees, your insurance next year would be unaffordable. So by putting you in a pool, it smooths things out. Insurers can adjust this rate for 3 factors only. So an insurer files a base rate with the insurance regulators in the state, in our case the Division of Insurance in Massachusetts. The division approves that rate, and then the health plan, the insurer, is allowed to make certain calculations to adjust that rate for the age of your employees, your business location, and the type of business. So we're not looking at your claims at all, just the age of your employees, where your business is located, because that's going to make a difference as to whether you're near an expensive hospital or a less expensive hospital, and also the type of business, because we know from experience that there are certain businesses that on average have lower claims costs than other businesses. This approach, as I mentioned, is designed to smooth out your claims experience. What it doesn't allow a small group to do is capitalize on its good experience. So an employer who has a lot of very young employees will get an adjustment for age, but if the employer has a lot of 50-year-old, very healthy people, their health won't be reflected, nor will any kind of special wellness programs the employer introduces to monitor blood pressure, a program to increase ergonomics in the workplace, a love your back type program to prevent people in the warehouse from having lower back injuries, those don't get reflected in the rate. So if you're a group of 50 or more, then insurers can start incorporating a group-specific experience. So it's important to understand these concepts so that you know if you're a group of 50 or fewer, the things that you do to make your employees healthy won't necessarily impact your rates. They're still important because absenteeism will be reduced, employee quality of life will be better, but it won't be directly reflected in your particular premiums. So let's look at strategies to manage your healthcare costs. This topic is obviously top of mind for employers and has been for many years, as you've seen double-digit increases, and even now as premiums aren't rising quite as fast as they were a couple of years ago, they're still rising faster than wages, which means that employee benefits, and specifically health insurance, is making up a larger and larger portion of the total employee compensation, which results in squeezing out other things, often like raises, continuing education, etc. So let's see how we can help manage those costs. One strategy is simply negotiate aggressively. Have a broker partner like Aisling Partners that can go to a health insurer, the incumbent, as well as prospective health insurers, and try to reduce the premium. That approach can work sometimes with larger groups, but obviously in the small group market, as we mentioned already, it's a community rate, and the insurer cannot adjust the premiums for a particular small group. A second approach is simply to adopt a wellness program. And adopting a wellness program, which can take many forms, will help improve the overall health, physical health, and perhaps mental health of your employees, reduce absenteeism, increase productivity, but again, it does not impact your premiums directly in the small group market because your experience is not factored in. Another way is to change a variable if you're a small group. As I mentioned, there are 3 variables that allow an insurer to adjust the base premium. One is employee age, second is company location, third is industry. So for example, you could change the composition of your employee mix by hiring younger employees as you increase your hiring. A second would be to move your company from an area that has higher medical costs to one that has lower medical costs. And the third, least practical, is you could change your industry completely. Another option is to buy down, and many companies have taken this approach during the last 4 or 5 years. What they've done is they have gone from a plan that was co-pays only to one with low deductibles to one with higher deductibles. What the company's really doing is shifting costs to employees by introducing or increasing the office visit, ER, day surgery, or inpatient co-pays, very often as high as $1,000 for an inpatient stay, or introducing deductibles. The final strategy, and the one that we want to focus on today, is what we call changing the paradigm. And what we're really doing here is reallocating premium dollars using a combination of a different kind of health plan with a reimbursement account that actually educates employees and incents them to become better consumers, and focusing on wellness as well. So let's look at this option, which we call consumer-driven health. Consumer-driven health defined is really several elements. First, the health plan with an individual deductible of $1,000 or more. And the idea behind a deductible plan is that employees have skin in the game. And by this, we simply mean employees are responsible for a portion of their expenses, and therefore, they have an incentive to shop more prudently. As we know from many other areas of our lives, people tend to spend their own money more efficiently, more effectively than they spend other people's. And when a patient is spending his own money at the lower end of the deductible as opposed to the insurers, very often those patients make different choices. The second important element is a tax-advantaged account to help pay deductible expenses. These accounts, and we'll talk about 2 of them in this presentation, are really designed as partnerships between employer and employee. So in exchange for having a higher deductible, the employee now enters into a partnership with the employer to create a vehicle to help pay for those increased out-of-pocket expenses. The third is a wellness program, which can control claims costs with larger employers, particularly where their claims costs are factored into their premium, increase productivity, and also increase the quality of life for employees. Information is another important part of consumer-driven health because people need information in order to become better consumers of healthcare. And finally, an incentive program, some form of tangible reward for being a better consumer. While all of these are important parts of the CDH program, we're going to focus today on primarily the first two, the health plan and the tax-advantaged account. Let's talk about high-deductible health plans. There are really two kinds of high-deductible health plans for purposes of our presentation today. One is a non-qualified plan, which we'll talk about now, and the next slide we'll talk about an HSA qualified plan. The difference between the two is simply one of them allows an individual to open a health savings account, which is one of the reimbursement vehicles we'll talk about, while one doesn't. A non-qualified plan in this context means a plan that has select preventive services covered in full, and nearly all health plans now have preventive services covered in full as a result of the Affordable Care Act of 2010. Office visits and prescription drugs are usually subject to copay. Diagnostics and treatment are subject to deductible. What we mean by diagnostics and treatment is everything from X-rays and lab work and MRIs and allergy tests to treatments like surgery, chemotherapy, other inpatient services, emergency room, physical therapy. Those are considered diagnostics and treatment, and those services are subject to deductible under these plans. And just to be clear, a deductible simply means the portion of the beginning expenses that an employee has to pay before insurance kicks in. This concept has become more and more familiar to people in the last few years in health insurance, but some people are still confused by the concept. The best analogy we can draw is when you have auto insurance and you have a $1,000 collision deductible, you understand that if you get in an accident, you pay the first $1,000 of expenses, and then your auto insurance reimburses the body shop for the balance of the work to make your car whole again. In the context of health insurance, we're talking about the same thing. If you have a deductible of $1,000, that simply means you're going to pay the first $1,000 of diagnostic and treatment services during the year before the health plan comes in and begins to pay. With a non-qualified plan, deductible range is typically anywhere from $1,000 to $2,000 for the individual policy and $2,000 to $4,000 for a family policy. Other states tend to have deductibles that are much higher. In Massachusetts, the limit for non-HSA qualified plans is $2,000 for an individual and $4,000 for a family. Under these plans, the family deductible typically has a maximum per family member. So a plan that has a $1,000 individual, $2,000 family maximum deductible, usually under the family policy of $2,000 maximum deductible, each family member will pay no more than $1,000 during the year. These plan designs are regulated by state mandates and guidelines. In the case of Massachusetts, the Division of Insurance reviews and approves all products before they're allowed to go to market. In just a moment, when we overcome technical difficulty here, we will move on to the qualified plans. Okay, we're having technical difficulties. I apologize. While we're straightening those out, I will tell you that The next topic we're talking about is HSA qualified plans, and they're going to differ in a couple of important respects here. And I will speak, you'll see the non-qualified plans slide still, and we'll talk about qualified plans. They cover select preventive services the same way, covered in full. The big difference is that office visits, all diagnostics and treatment are going to be subject to deductible. So under the non-qualified plan, office visits and prescription drugs are subject to copay. Under an HSA qualified plan, everything that is not a select preventive service will be subject to the deductible. And that includes office visits and prescription drugs, as well as the other diagnostics and treatments that we talked about earlier. The deductible on these plans is typically higher. It's usually $1,500 to $3,000 for an individual policy and $3,000 to $6,000 for a family policy. The family deductible usually does not have a maximum per family. So if you're covered under a family policy with a $4,000 deductible, in most cases, any single family member or combination can reach that $4,000. These products are regulated not only by the states, but also by the federal government. The Health Savings Account program is regulated by Section 223 of the Internal Revenue Code, as interpreted by the Internal Revenue Service. So in addition to having the states approve the products to make sure they incorporate state mandates, the federal government has basic design criteria that each plan must meet. Individuals enrolled in these plans who meet certain eligibility criteria, which we'll talk about in the HSA section, can establish and contribute to a health savings account. Let's talk about health reimbursement arrangements. Our next section is going to talk about the two accounts, health reimbursement arrangement and health savings accounts. And we're going to start with the health reimbursement arrangement. An HRA is really an employer-funded, which means self-insured, limited benefit health plan that an employer offers to help employees offset some of their out-of-pocket expenses. Essentially, the way you design an HRA is you introduce a deductible product or increase the deductible on an existing product, and then incorporate a health reimbursement arrangement, which simply allows you, the employer, to reimburse some of your employees' eligible expenses with pre-tax dollars. You, the employer, design the HRA. You determine the value, which expenses are eligible for reimbursement, payment order, and other important criteria. Let's look at how an HRA works. And bear with me here, the slide is a little bit busy, but let's go over it. You have a current plan, and it's time to renew. So your anniversary is coming up, and you have a choice. You can either renew your existing plan, and in this case, you received an 8% renewal premium. So for an individual, you were paying $5,000 total per year this year. In the next year, that premium is going up to $5,400. You also look at a plan that has an HRA with a deductible, and that plan is $4,800, which is actually lower than your current premium and $600 lower than the renewal of your existing plan. Now, I'm assuming in this scenario that the employer, you, pays 70% of the premium and the employee pays 30%. So we've broken down that $600 premium savings under the HRA option into $420 for you, the employer, and $180 for the employee. The deductible under the HRA option here is $1,000. You've designed an HRA to pay the first 50% of your employee's deductible expenses. So you will reimburse them the first $500 from your money, and then the employee will be responsible for the next $500. So let's look down at the bottom, and you see that you, the employer, have your $500 HRA, which you fund with $420 in savings versus renewing the current plan. Your employees may have up to a $500 liability, and they have only $180 in premium savings to offset that $500. So where are the savings under this plan? The savings come about because not everybody, not by a long shot, reaches his deductible in a given year. On a Best Buy HMO 1000 plan, which is Harvard Pilgrim's $1,000 individual deductible plan, about 40% of employees have deductible expenses of less than $100. They average about $16 in deductible expenses. So if you have a group of with 10 individuals, 4 of them, even though you've promised each one of them $500, you'll pay out an average of only $16. About 20% of them will have expenses between $100 and $500. Again, your $420 premium savings per employee will more than compensate for any reimbursement you have for these employees. About 20% are going to hit the second half of their deductible without hitting the maximum, and in those cases, you will pay out $500 in exchange for only $420 premium savings, while the employees are slightly worse off because they had $180 premium savings, and they're going to have to pay something toward their deductible after you pay your $500. About 20% of the employees will reach their full deductible. For each one of them, you, the employer, are going to pay out $500 against your $420 premium savings, and the employees are going to pay out $500 less their $180 premium savings, so they'll be $320 in the deficit. So what conclusions can we draw from this kind of program? Well, several. First off, the employer is going to come out ahead with about 55% of the employees, and about 70% of the employees are going to be better off versus renewing with the traditional plan that had no deductible. This is a very important point to understand here for the employer. On average, an HRA pays out about 60% of the promised benefit. So in the case of our illustration here, you're promising you'll pay the employees first $500 of deductible expenses. On average, that promise to pay $500 will cost you about $300 per employee because you're reimbursing expenses only as employees incur them. If they don't incur deductible expenses, you don't pay. So you are achieving premium savings of $420 per employee, and you're paying out an average of $300. 70% of your employees will be better off in a given year versus renewing their current plan. So 70% will pay less under this program than they would have absorbing the increase that came along with the renewal of the current plan. Those 30% who are not better off are generally high utilizers. You as the employer can offer them a health flexible spending arrangement to help them offset their higher expenses. The Health FSA is not a subject of today's topic, today's webinar, but many of you know a Health FSA is a great opportunity for your employees to use tax-free dollars to pay for medical, dental, and vision expenses. The key question for an employer introducing this kind of plan is this: am I willing to introduce a program that creates savings for me, the employer, and for more than 2/3 of my employees when I know that about 1/3 of my employees who use the plan most must pay a little bit more? And that's really more of a philosophical than it is a financial question, and an employer needs to feel comfortable in introducing this kind of plan given the reality that some employees will pay more in a given year than they would have renewing the non-deductible plan. There are several issues with HRAs that I want to bring up but not discuss in great detail in this webinar, but certainly Aisling Partners and your representative will be able to talk about these in much more detail should you be interested in this kind of program. You do need to offer the HRA to COBRA participants. Certain business owners cannot participate in an HRA. So if you are a partner, a member of an LLC, or a 2% or greater owner of a sub-S corporation, you can offer an HRA program to your employees, but you and your immediate family members employed in the business cannot receive tax-free reimbursements from an HRA. Also, certain individuals enrolled in a health plan cannot receive tax-free reimbursements. These include same-sex spouses and domestic partners, if they're allowed to be covered under the plan, as well as ex-spouses that your employees cover due to a court order. It's also important to understand an HRA is a health plan, and it does have required documentation and adherence to federal rules. The good news is when you offer an HRA, you hire a third-party administrator that is expert in managing these programs and can take care of all of the paperwork and compliance for you. Another important point here is the employer's liability is capped. So you know if you have 10 employees and a $500 HRA for each one of them, the maximum you're going to pay out is $5,000. As we've seen earlier, in all likelihood, your experience will be much lower, but absolute worst case scenario, your liability is capped at $5,000 in that scenario, but it is variable with uncertain timing during the year. And what that simply means is we know that those 10 employees, on average, you will pay out about $3,000 in HRA expenses during the year. What we don't know is whether this year it's going to be $3,500 or $2,500. We also don't know whether the $3,000 you pay out is going to occur in even increments during the year or whether it's going to be in 1 or 2 given months, which could have some effect on company cash flow. Harvard Pilgrim offers integrated HRAs with a handful of preferred partners. So if you decide to go down the road of HRAs and choose a Harvard Pilgrim product, then we have relationships with a handful of HRAs, administrators, and in our integrated program, we send a weekly electronic eligibility file to the third-party administrator to make sure the health plan and HRA enrollments are in sync. We also send a weekly claims file of all claims that are eligible for reimbursement so that employees don't have to file paperwork in order to receive their reimbursement. We have preferred pricing for HRAs and also for an HRA-FSA combination, and you have the choice of sending reimbursement to the provider or directly to the employee. Now let's shift gears and talk about the other account, a health savings account. A health savings account is nothing more than a tax-advantaged checking account that eligible individuals can establish, and they use it to pay for health-related expenses. Unlike the HRA, which is employer-funded, an HSA is funded by the employee and the employer at the employer's option. Funds related to an HSA are triple tax-free. Any money an employee puts in through pre-tax payroll contributions is tax-free. The balances grow tax-free, and any distributions made for eligible expenses are also made tax-free. Another very important difference with the HRA is an HSA is a financial asset. So while an HRA is an employer-created reimbursement account, a health savings account is an actual financial asset that the employee owns. The employee manages that account, the employee earns interest and can invest balances, and HSAs are an inheritable asset. With this tremendous opportunity come a lot of strings. And the first I want to talk about are eligibility requirements. The Internal Revenue Service determines who's eligible to open and fund a health savings account. The health plan itself is regulated by the Internal Revenue Code and the state and the requirements of the particular insurer, but the IRS is determining who can open the account associated with that health plan. And to be HSA eligible, an employee must be enrolled in an HSA qualified plan. Be sure to check with your Aisling partner representative to determine whether or not your plan is HSA qualified. Also, employees cannot be enrolled in a second commercial plan. This used to happen in the olden days, not so much now, where an employee was also covered under his spouse's plan. You can't be enrolled in any part of Medicare or Medicaid. You cannot have a traditional HSA in the family. So you, the employee, cannot have one, nor can your spouse have a traditional health FSA. If you do, you are not HSA eligible until after the end of the FSA plan year. You also cannot have received non-preventive care during the last 3 months from a Veterans Administration facility. And finally, you can't be someone else's tax dependent. So one of the downsides of an HSA, unlike an HRA, is there are a lot of eligibility requirements that you don't see in the HRA world. If you're eligible, then you can make contributions into your HSA. Employers and employees can contribute. Employers are not required to contribute to employees' HSA. Most employers do, particularly in the first or second year of the program, to ease the transition to a high deductible plan. And employers generally fund these contributions with their premium savings associated with a plan with a higher deductible and therefore lower premium. Employees themselves can make pre-tax payroll contributions, and the benefit of this is employees don't pay federal payroll taxes or federal or state income taxes. Employers do not have to offer employees the option to make pre-tax payroll contributions, but usually it makes sense financially because you, the employer, don't have to pay your portion of the FICA tax when employees contribute through pre-tax payroll. It's also important to note for those of you familiar with a health FSA that under an HSA program, employees are not locked into an annual election. They can front load their plan, they can back load it, or they can do level funding and then 5 or 6 months into the plan year decide they need to change their amount as their needs change. This feature is very different from a health flexible spending arrangement. The IRS does set annual limits on how much individuals can contribute to their HSAs. These limits are based on a calendar year, regardless of your plan's anniversary date, and includes contributions from all sources, generally employer and employee. These figures are also adjusted every year for inflation. So for a single person coverage, the limit for 2012 is $3,100, and that will be inflation adjusted to $3,250 next year. For a family, the contributions are always about double the individual. So in 2012, $6,250 and $6,450 in 2013. Also, a provision of the law allows anybody who's age 55 or older to contribute an additional $1,000 per year into his HSA. The $1,000 figure is not indexed for inflation. Employer contributions are in the form of cash and they vest immediately. So unlike an HRA, where the employer is paying as employees incur claims, under an HSA, the employer is giving employees cash whether they actually need it or not at that given time. Employer contributions are also subject to certain discrimination rules, and an HSA trustee will be able to help employers understand the implications of rules around discrimination. Distributions. So once you're eligible to establish and contribute to an HSA, once you start making contributions, for what expenses can you reimburse through your HSA tax-free? And the answer is that an employee who owns an HSA can make tax-free distributions for his own, his spouse's, and his tax dependents' eligible expenses. Now, the expenses here are very similar to those for a flexible spending account. Those of you familiar with a health FSA know that medical, like deductible and copay, certain non-covered medical expenses, non-cosmetic dental and orthodontia, which means almost anything that goes on in the dentist's office except teeth whitening, prescription glasses and sunglasses, contact lenses, vision correction surgery, and over-the-counter equipment and supplies are all eligible for tax-free reimbursement. In addition, as a result of the Affordable Care Act of 2010, over-the-counter drugs and medicine are reimbursable, but only with a valid prescription. In addition to those expenses, an HSA owner can reimburse certain insurance premiums. For example, the employee is continuing coverage under COBRA or is collecting unemployment. In those cases, the health insurance premium can be reimbursed tax-free from the HSA. In addition, for employees who have rollover money available and carry balances into retirement, they can reimburse their Medicare premiums, plus the premiums for many Medicare supplement plans. In addition, employees at any age who who carry long-term care insurance can reimburse their premiums from their HSA tax-free. HSA issues. There are certain issues to understand as there were with HRAs. First, the employer HSA contribution program is not subject to COBRA. Unlike the HRA, under the HSA program, the health plan is subject to COBRA, but an employee's schedule of contributing to employee HSAs does not carry once the employee leaves employment. Those certain owners who could not participate in an HRA are allowed to fully participate in a health savings account, but they do face some restrictions in how they contribute. Not how much they contribute, but the mechanics of getting the money into the account. If you offer an HSA program and allow employees to make pre-tax contributions, you need to amend your Section 125 documents. Otherwise, you do not need any other special document to run an HSA program. Another key feature is the employees themselves are responsible for keeping their HSAs in compliance with federal rules. You, the employer, do not bear that responsibility. And finally, employer contributions are defined in amount and timing, which makes for more budget certainty than the HRA. The advantage of the HRA is that for every dollar you promise to reimburse, you're laying out about 60 cents. With the HSA, for every dollar you promise, you're giving the employee a dollar in cash. The difference is, with the dollar in cash under the HSA, you know when and how much you're spending for your employer contributions, whereas in the HRA, the amount you actually have to pay is going to vary month to month. Harvard Pilgrim has 3 preferred HSA trustees to whom we send a weekly eligibility file and deliver preferred pricing. All 3 of them offer very similar features, and these are features that are similar to what any HSA trustee will offer. An HSA looks very much like a checking account. Employees can access their money by debit card, checkbook. There's usually the ability to pay providers electronically, FDIC-insured cash account paying market interest rate, investment options, toll-free customer service, low or no-fee HSAs, as well as monthly statements and annual tax statements. Let's take a moment to breathe. We've gone through a lot so far. We've talked about non-qualified plans with HRAs, qualified plans with HSAs, and it may all sound a little bit confusing. That's why you partner with someone like Aisling Partners who can help you understand and sort through everything we've talked about in this presentation. I want to conclude by talking about which plan is right for your company. Without knowing more about your company, I can't tell you whether an HRA or an HSA program makes more sense for you. But I want to give you some guidelines to consider to help you perhaps narrow down in what direction you want to go if you're ready to adopt or strengthen your consumer-driven health program. Some of the questions to ask yourself are my employees financially sophisticated? If they're not, then an HRA is better because the HRA is administered by somebody else, not by the employee. If you have employees who are looking for new ways to save on income taxes, then an HSA is a better program because HSAs allow employees to make pre-tax payroll contributions. If your employees have a lot of out-of-pocket dental and vision expenses and you don't offer a health FSA, then the HSA is a great vehicle because it allows them to put money aside to pay those expenses tax-free. If you want to maximize the amount of your employee's deductible that you're reimbursing, an HRA is better because, as we've talked about earlier, for every dollar that you promise, you're going to pay out about 60 cents. With an HSA, for every dollar you promise, you're going to pay a dollar in cash. If your employees are on financial overload already, they don't have bank accounts, they don't speak English very well, then an HRA is a better program for them because the mechanics of it are done behind the scenes and the employee is not directly involved in managing an account. If your employees want additional investment vehicles, if they're higher income employees, if they've maxed out their qualified retirement plan, and want to have additional opportunities to reduce their taxable income, a health savings account gives them that opportunity. So those are some of the employee factors to consider. But what about you, the employer, and the things that you're considering? If you want to stretch your reimbursement dollars, the HRA is better. Again, you promise $1, you'll actually pay out roughly 60 cents. If you want budget predictability, an HSA is better. Even though you're paying out 100% of what you promise, you're doing it on your schedule. If you don't want to manage a reimbursement program, an HSA is a better option. An HRA is a health plan and does require you to manage and oversee it, even though you're shifting some of that responsibility to a third-party administrator. If you don't want to pay the administrative costs of a program, an HSA is better. HRAs run through a third-party administrator incur administration costs the employer absorbs. With an HSA, if there are monthly fees, in most cases, the employee, the HSA owner, pays those fees. If you want to maximize your premium savings, the HSA program is better. Because more services are subject to deductible, these plans have lower premiums, roughly 8 to 10% below a comparable deductible plan that would go with an HRA. And finally, if you have a family business, so that many family members are covered by the health plan, and you want them to have a tax-free opportunity to reimburse expenses, the HSA is better. Remember, members of an LLC, partners, and 2% or greater owners of a sub-S corporation are not eligible to get reimbursement out of an HRA. They can fully participate in an HSA with just a couple of restrictions on how they put the money into the account. Finally, you need to look at a lot of factors to determine which plan is right for you. The best approach, and the approach that more progressive employers are taking, is really not to react year to year to premium increases, but rather to take a longer 3 to 5 year look at where you want to be and figure out what steps you need to take to get there. And finally, Aisling Partners is an invaluable resource in helping you to assess market trends, to look at competitive products, and to be on top of innovative approaches like consumer-driven health that will help you control premiums this year and into the future. That concludes the formal part of our webinar. We are now open to questions for any of you who want to unmute your phone and ask a specific question. Last call for questions. If you have a question, I'm happy to answer it. If it's something that you'd rather discuss with your Aisling partner representative, you're welcome to do that. The lines are open for any final questions. Going once, going twice. If there are no questions, I'm going to turn it back over to Todd to conclude this educational program.
Bill, thank you so very much for your very insightful, relevant, timely topic. Hopefully all of you on the call today certainly garnered a little bit of information and a better understanding of consumer-driven health plans. We want to certainly thank you for taking time out of your day, and hopefully you found this valuable and well worthwhile. While you're on our website, you are certainly welcome to download this presentation, and you may also sign up for our next webinar, which will be July the 17th at 11 a.m., and this will be an informational session on FMLA. And again, thank you all, and for any questions or issues related to today's topics, please just contact one of us at Aisling Partners, and we'd be delighted to help and assist. Thanks so much.